Thanks for that. Yes, that's correct. Credit Suisse Outlook 2021 is out, and one of the most followed strategists on the street, Neelkanth Mishra, is here with me to talk more about that. Neelkanth, good afternoon. Thank you very much for your time. Your note says that in the next 4 to 6 months, cyclical growth actually could surprise on the higher side. I want to understand from you, what are the drivers of this surprise growth which you are talking about? Some on the street are already surprised by the numbers which have come in so far. The shrinking was lower than expected and the rebound is sharp. But you're making a case that there could be some more upside to this cyclical growth rebound. Talk to us about the drivers which you are reading ahead.
Yeah, and so thank you for having me, and it's an absolute pleasure to be here. So the growth surprises that we are talking about are driven by, one, the unhinging of the statistical numbers as we saw a very steep decline, right? So what happens is most people, so if suppose you start at 100 and then you go to 76 like we did in the June quarter. To go back to 100, you have to go up 33%, right? And I think writing that 33% number looks a bit odd, even though people may not explicitly be doing that. So I think the FY22 over FY20 growth rate, which is currently at plus 1% or so in consensus numbers in GDP growth, I think can end up at 3 to 4%. Basically, that there can be a 2 to 3% at least growth forecast increase in FY22. The second is that the period running into the pandemic, we had seen intense destocking across supply chains because of financial system stresses. So as the supply chains and then reduced inventory, retailers, wholesalers, distributors, if the end demand was say plus 3%, what the manufacturers saw was maybe minus 3, minus 4%. And this meant much lower output, right? GDP is output. But as the inventory levels have normalized, meaning they can't go any lower, the plus 3 starts becoming visible to the manufacturer as well. And I think the output levels start to go up. That process had taken 15, 18 months to on the one cannot get over in 2 to 3 months. And therefore, we think that this can be a positive surprise. The third element is the fiscal one. So in the September, you may have noticed that government final consumption expenditure was down nearly 20% year on year, a large part of it because of state governments. And so the fiscal headwind that people fear could emerge toward the end of the financial year, in my view, has already happened. In fact, it was very visible in the September quarter. In fact, what has happened now is that in the second half of the fiscal year, the tax growth that is coming through for the states and the center is going to be far better than what was there in the first half. And I think the fact that the central government decided to clear fertilizer subsidy arrears is a sign that they are actually not under fiscal stress at all. And I think that the normalized spending by state and central governments can be a tailwind to growth. And lastly, of course, there's the global cyclical revival. So as you may have seen, global IP has struggled in the last 1 or 2 months as the Western world has gone back into lockdowns. And as the things start opening up, say by Feb, March, when sufficient vaccination has started to happen, though this process will take, I think, 5, 6 months at least, we expect that also can be for the Indian economy.
Right. Neelkanth, how much of this growth which we are talking about, which continues, how durable will it be? How much prolonged could it be? Could it face hiccups? And the bigger question also, while some are talking about, is how much of that is already in the price. You did briefly touched upon that in your report as well. But your comments on the durability of this growth and how much is the street factoring in already?
Excellent question. So see, the first correction, the first comment I would like to make is that in the last 10 years, we have steadily seen India's medium-term growth rate being revised downwards, right? So over the past 25 years, we have grown at nearly 7% CAGR. 20 years also the same, 15 years is the same. From what used to be the 8+6 formula, right? So 8% GDP growth real, 6% inflation, so 14% nominal GDP growth, which was a norm 10 years back. We have now come to a point where even before the pandemic, many people had moved to a 6% growth and of course a much lower inflation number. Now I think is a time when perhaps some of those numbers need to be revised upwards. And the first reason for that is that the monetary conditions are a lot easier than they were. We had excessively tight monetary conditions. Some of it was warranted because we were fighting very high inflation, but I think we kind of overdid it. So the M3 growth, that is a broad money supply growth in the 2016 to 18 period, was meaningfully below nominal GDP growth. So this was a unnecessarily tight monetary regime, which I think is now eased. And some of the easing is also kind of involuntary in the sense that we have seen a balance of payment surplus, which is far, far bigger than what anything we have ever seen. And you must have seen that foreign currency reserves have gone from $468 billion to like $579 billion in 8.5 months. There's like 4% of GDP added in like 8.5 months. So this has forced the RBI to print a lot more money. And the result of that has been like 7 lakh crores, 7 trillion rupees in the deposited with the RBI overnight. And therefore, suddenly there are large firms, of course, the good quality firms, borrowing below the repo rate in the short-term markets, which is quite remarkable. So there's been monetary easing. The headwinds from the real estate market have disappeared, meaning the real estate market had been stagnating and slowing for several years. And that was in its own way creating stresses. That has disappeared. Of course, there have been labor law changes, corporate tax rate has been cut. But I think the most important change that has happened in the last 2 months is the PLI schemes, the production-linked incentive schemes that the government is embarking on. This is a remarkable change in India's industrial policy on many counts. The first is the first time that the government is giving money for companies to grow. And you can see the excitement in the country, in the economy, or in the companies that hope to benefit from this. The second is that the government, instead of spreading it out thinly when it would not, because the government has limited fiscal resources, the government is saying, look, I am going to not say if I have 100 rupees, I'm not going to give 1 rupee each to 100 companies. I would rather give 10 rupees to 10 companies. And so that it is meaningful enough for them to, and it will be linked to performance. And then it will be delivered and it will deliver performance. Interestingly, if there are 20 applicants, I will choose the 10 largest firms. So the government realizes that especially in the export market, it's important to have size and scale. And these are all very strong shifts in India's industrial policy. So as a meaningful amount of money starts to get allocated to these schemes, it is very likely in our view that medium-term growth outlook. So we estimate about 1.7% of GDP of additional output, incremental output coming out just because of the PLI schemes. And I think while most of the revenue counters, the clock will start in FY23 because firms will be told if you can grow, say 10% or 15% or 20% annually, we will give you say 5% of revenues or 7% of revenues. The investment required, because most of these schemes will require that these new revenues come out of new projects, new plants, the investment required will actually happen in a hurry in FY22 itself. So I think some of that momentum. So I do think that this momentum can sustain, and in fact, it can actually sustain for a while. There's a lot of ifs and buts. Let's see how the details of these schemes are announced. Of course, we will have to recalibrate after that. As of now, we only know the numbers and the broad areas where the government wants to focus. What the details of the schemes are, once we get that, we'll revise them. But I think these are very positive omens for medium-term growth. How much of it is priced in? Quite a bit of it. As you know, the Indian market has rarely been more expensive. In fact, if you take the Nifty at current levels, and if you assume the plus 21% in FY23 on top of a plus 40% in FY22 index EPS is to be delivered, in December 21, we'll be back to where we were in January 20. So the market is not cheap. I think quite a bit of the growth is priced in. But we think that because, as I said earlier, FY22 GDP itself, I think needs to be bumped up. I think that will also mean that many bottom-up analysts will be, sector analysts will be forced to move up their earnings. And as the excitement around the FY23 onwards, the growth pickup because of PLI comes in, I still think that the market has upside.
Right. Neelkanth, I really like the way you put at least the prima facie numbers to it. Everybody is inquiring about PLI and its potential. And surely it will get finer as we move forward and details trickle in. Let me take, let's take a step back. The way the market is actually factoring in this growth, the way global commodity prices have rebounded very sharply. You've tracked commodities for a long time earlier as well. Cyclical trade via banking or even deep cyclicals like LNT have started moving. What kind of portfolio construction are you talking about within your team, in your clients, your overweights, the best way to play it, and where does the broader end of the smaller companies figure in? Usually when this kind of a cycle turns, what does these smaller companies have a role to play? Your thoughts on that?
Again, great question. So we are so our biggest overweights in the model portfolios, as you know, we run a model portfolio which is an indicative portfolio for our clients to show which sectors we prefer. So our biggest overweights are on banks, one PSU bank, several of the private banks, and industrials and metals. Right. So in metals, in fact, we have been overweight for a while. It has worked nicely. After being very painful earlier in the year, but now we have recently actually tactically increased the weights further. So generally, when stocks move up, you would want to take some money off the table. But I think that the flare up that we are seeing in iron ore, for example, I think that means massive cash flows for Indian firms. And what I see from our global commodities teams is that they are thinking of $150, $160 iron ore sticking around or staying for quite a while longer. If that was to happen, then of course there can be significant upside. But right, these weights in metals. So banks, industrials, metals are, and I would include autos in that. That is four-wheeler autos. We are quite constructive. On the small mid caps as well. See, I generally, because I try not to classify that as one asset class. All I will say as regards small and mid caps is that many of the firms that benefit from the PLI schemes will be mid caps. So while they are very large in their own subsectors, in the larger scheme of things in the stock market, they are still classified as mid caps, and that's their size, but their growth can be meaningfully higher, and therefore I think that so those kind of names can do well. They can be in apparel, they can be in food processing, they can be in marine exports, whatever, and then because these are the sectors that the government is incentivizing, or there could be auto components, and then there will be the industrials, right? So because of the multi-year slowdown that we have seen in capex, many of the industrial names have also, I think, remained mid caps, or some of them have become mid caps, and I think the pickup in investment intentions is something that we expect will also boost the prospects for these stocks in the coming 12 months. But I won't generally go and buy all mid caps and small caps because rising tide lifts all boats. That's generally not our investment style. I would rather have a fundamental backing to it.
Sure. Fair point. Neelkanth, since we are having this chat and your firm globally has a very good handle on things going around, a view I wanted from you was regarding FII flows. You interact with some of these clients which are participating heavily right now in India markets. We have never seen this kind of a concentrated big flow into Indian markets for a very long time. Some of us who've been around just 1.5 decades perhaps have not seen it. I mean, dollops of liquidity is coming in. Some, of course, is going to other emerging markets as well. What are your thoughts on the way things are shaping up? And is it the long EM, short DM trade which is happening. What exactly is going on?
Yeah, so it is partly that. There are multiple aspects to this. The first is that near term, a large number of uncertainties have gone away. So just like you were asking about small and mid caps in India, EMs are somewhat of the small and mid caps in the world, and I think the investors have been global asset allocators more than the FIIs themselves. The asset allocators have been very cautious and conservative because they were unclear on how long this virus lasts, because we were starting to have repeated lockdowns. The lockdowns are very disruptive to economic growth potential, and you didn't even know which industries would survive, which firms would survive, and all that. So as the vaccines came out, I think the visibility on what the economy may look like 1 year out. So right now, of course, we are seeing through a very bad wave of unfortunate deaths and lockdowns again in Western Europe and the US. But the expectation is that in a year's time, all of that will be history. So it is time to take some risk. And I think that's of course been one factor where a lot of the money that was kind of lying on the sidelines has now been deployed. The second is, of course, the EM to DM or DM to EM, or rather, I would say the weak dollar trade, where investors who were kind of hiding in dollars because they thought they needed a safe haven are now starting to move back and sort of normalize their portfolio holdings. There's been a third factor here, which is, of course, India's weights have gone up. So some time back in our Asia thematic strategy, we published a note where we analyzed the money and capital flows across the world. What was surprising to us is that despite zero interest rates, and this is actually quite unconventional. See, people somehow naturally assume that the 0% interest rates will drive strong capital flows across the world. That has not been happening. In fact, you'll see surprising trends that despite negative deposit rates in Europe, 60% plus of incremental household savings are still going into deposits. And in fact, flows into mutual funds in the US have been very weak in the last decade. One of the reasons why the US equity markets have done well is because of corporate buybacks, right? It's not because of strong inflows into mutual funds. In fact, pension funds in the US, which are the primary vehicle, so that's the asset class which somehow comes into emerging market funds or Asia funds, that has not seen very strong inflows. So what that means is that this surge in flows that we are seeing is something that we think will last maybe a couple of more weeks. But this view that is forming that there is several $100 billion coming in the next 2 years is something that I don't necessarily agree with. We think that the structural plumbing, at least I think that the structural plumbing behind some of these flows is not as healthy as it was 15 years back. India and China is also benefiting from, and so what happens, in global flows is that the plumbing matters. A lot of the flows are not just the passives, right? Also the benchmark flows. See, however much the active weight, if India's weight in emerging market is say the EM funds is say 8% or 9%, then that much, you'll get 7% or 10%. You won't get 0% or 20%. So the thing is that if, as the reliance on benchmarks has gone up, and particularly in say even bond markets, I think the amount of assets going through those pipes has increased. And so the rise of China's weight, the rise of India's weight has also meant that these countries have got a disproportionate amount of funds. In many cases, funds have been pulled out of the emerging markets. So when you think about that level of detail into what drives fund flows, you realize that what we are seeing right now is partly because India's weights went up, partly because the risk on because of vaccines, because of the end of the US presidential elections, all of that has driven it. My sense is that these flows will not last more than a few weeks from now. There is a momentum, so it will last a while, but this is not a 6-month, 12-month story.
Right. All right, Neelkanth, we'll let you go on that one. Thanks so much for discussing your thought process with us. So have a great weekend ahead, and of course a great year 2021. Thanks so much for your time. Always we value your contribution on the channel.
Great being here, and all the best to you.